how do you think, a doctor can start to kind of break free from that feeling of, I just don't understand my numbers and it's so foreign to me?
Sometimes it's hard to know what the point is. Like, okay, my overheads, I spent $30,000 on my staff this month. I know the number, but why? Like, what's the point? I have $70,000 in my bank account. What's the point? I think it's hard, to be a good accountant, and not that to make it about myself, but and when I think about numbers, it's like step one is to know the number, and then step two is why? What are you going to do about it?
Hello and welcome back to Ali Off the Record. I'm your host, Ali Oromchian, and today's guest has made it his mission to help doctors run stronger, more profitable practices, but actually understanding their numbers. Joining me is Travis Slade, CPA and founder of Uluru Advisors. And you may not know what Uluru is, but we talk about that in our session. But before becoming an accountant for doctors, he spent some time inside his brother's dental practice where he saw the firsthand struggles that owners face, especially his brother. And that experience sparked a passion to help you doctors, not just to survive, but to actually thrive, So over the past decade or so, he's been a trusted resource for all doctors nationwide, and he helps them manage their taxes, apply GAAP standards, and just make smarter financial decisions. So in this episode, we're going to dig into the financial habits and management strategies that you need to keep your practice healthy, from avoiding common tax pitfalls to creating systems that reduce stress and building confidence in your numbers. Travis is sharing practical advice that you can start applying today as a practice owner. Stick around, you're not going to want to miss this episode. Hey, Travis, it's great to have you on today. So welcome to our podcast.
Thanks for having me, Ali. Great to be here.
Yeah, my pleasure. My pleasure. Now, I know we're going to talk about a lot of CPA stuff, and accounting stuff very soon, but your history is kind of unique for CPAs because didn't you start working in was it your brother's dental practice?
Correct. Yep.
Yeah. Yeah. So tell me about that. What did you do for him?
Yeah. So my degree was in accounting. And while I was studying accounting, I said, I will never be a CPA. Those people are lame. I'm never going to do that. And then fast forward a couple years later, and I'm a CPA. But no, what had happened, I was in San Francisco in finance and working with big startups. And I felt drawn to small businesses. And my brother owned a dental practice. And I was always asking him questions just about his business. And he was like, just come work for me, man. And so I joke, I had an offer to do investment banking in San Francisco or to go be an office manager in a dental practice.
Yeah.
And, you can guess what option I chose. But the goal was to grow his practice. I didn't realize it at the time, but we wanted to create a DSO. I didn't realize that was the terminology, but we wanted to open up multiple practices. And so that's how I got into it. I was coming to do the business stuff, and it didn't go super well for my brother and his practice. And there were a lot of things I didn't realize before I went over there. I didn't realize he had made certain decisions and done certain things, and those were not great decisions. And that put this bee in my bonnet of, holy crap, there's all these dentists who spend a decade going to school, hundreds of thousands of debt, and then they can make a couple decisions to squander that, and that broke my heart. So ever since then, I've been trying to help dentists make good decisions and centered around accounting.
Yeah. Well, actually, it's funny you say that because as you've heard me speak a lot, and kind of what we talk about to young dentists and not just young dentists, but young doctors across the country. And one of the things I always say is that it's the little things in their practice, the little decisions that they make that has the biggest impact on them financially, legally, and otherwise. And most of our doctors are worried about, am I going to get new patients and how's this going to work? And all those bigger things that are can kind of strike fear in people in terms of doing well, but it's not about those. It's typically these little financial decisions, little legal decisions that people sometimes don't do well that ends up costing them a ton later. So I don't like that your brother went through that experience, of course, because I want all of our doctors to do really well. But for you, it was probably an awesome experience to see that and be able to use that as a tool for your own clients.
Totally. 100%. No, I'm very grateful for it. And, I felt like I was living in the shoes of a practice owner for a year and making decisions I shouldn't have been making. And everyone called me Dr. Slade, actually, when I was there, because his first name's Troy, my name's Travis. People just couldn't keep us straight. Yeah. And I didn't like that. I felt like I'm undeserving of to be Dr. Slade. But no, I felt what it was like, and I know the pains for sure.
Yeah. Well, good. Well, okay. So tell us a little bit about, before we get into sort of all the nitty gritty stuff, tell the audience a little bit about Uluru Advisors and what your firm focuses on, just high level, and then we can get into the details.
Yeah. So we have an accounting firm, started an accounting firm for dentists. And I've been inspired by the Australian outback, and which most people have not been there. And for good reasons, because it's dry, boring. It's a desert. Like, who wants to go to a desert? But in the middle of the Australian outback is this massive rock that comes out of the ground. And it's like the one thing to go to in the Australian. It's like the one place you go to in the outback. Yeah. And that rock is called Uluru. And I feel like accounting is like the Australian outback. It is boring, bland. No one wants to be an accountant. The industry is dying. There's like, in the world of CPAs, there's like, what are we going to do? There's a shortage of CPAs. No one wants to do it. But I want to be like the Uluru of accounting and stand out in a boring place and give people a good destination to go to.
Dude, I love that. I love that story. I love that name. I never knew the history behind it. And that's pretty cool. That's really, really cool. And what's funny about that is that I've never been to Australia or the Outback, but now that you've said this, I'm going to absolutely aim to go, and I'm going to be thinking about you when I'm there.
Yeah, I haven't been either, honestly.
Oh, you haven't? Oh my gosh.
No, I've not been. It like the Australian, yeah, it's a long story. But I didn't even say the name of this rock, Uluru. I guess it's like, think Australian kangaroo, right? Kangaroo, Uluru. That's kind of how you say it. But
okay, Uluru. Okay,
yeah, right. Never been, so I got to go. If you go, let me know so I can hop in your luggage.
You got to work on your Australian accent when you say it. I think it'll just sound better.
Yeah, so. I saw a lady at Trader Joe's, and I could tell she's from Australia just the other day, and I'm like, hey, how do you say the name of that rock? I don't want to say it. It's like, how do you say the name? And she's like, it's just Uluru.
Of course.
Uluru.
Yeah,
I'm like,
course.
okay.
Okay, that's funny. Okay, so let's jump into this a little bit. So we've got a lot of doctors that say, I just don't understand my numbers. I'm a doctor, that's what I focus on is my patient care. I just don't get what these numbers mean. So before we really jump into it, why do you think that's so common? And how do you think, a doctor can start to kind of break free from that feeling of, I just don't understand my numbers and it's so foreign to me? Like, let's go through that psychology first.
I feel like because sometimes it's hard to know what the point is. Like, okay, my overheads, I spent $30,000 on my staff this month. I know the number, but why? Like, what's the point? I have $70,000 in my bank account. What's the point? I think it's hard, like, to be a good accountant, and not that to make it about myself, but and when I think about numbers, it's like step one is to know the number, and then step two is like, why? Like, what are you going to do about it? And I feel like a lot of times it's hard for people to know, why do I care about the number? How is it going to change a decision?
Right. And do you think they don't understand how the numbers helps them make decisions? Or do you think they look at the numbers and think, it's not going to make a difference in terms of my decisions. I'm going to make my decisions the way I think I need to make them to make my practice successful. And that's why they're not focusing on it.
I think it's both. Yeah, there's definitely some people that it's like, who cares that my supplies is 8% of overhead, I'm going to buy the supplies I want. I'm not changing my glove preference purchase,
Right.
like I want the supplies I want. But I think a lot of times, so that could be one element. Another element could be sometimes how the information is presented
Yeah.
is really hard to like decipher. Like there are people that have accountants that are still giving them the P&L in alphabetical order, and it's not organized by like
Right.
categories and
Sure.
sections and stuff. So it's
Yeah,
like
I've seen
sometimes
that.
it's like
Yeah.
it's hard to know like what the number is, and then even then, like I don't think people are interested in changing behavior.
Right.
But I think it's like, I would push that mindset as much as possible. Like if you, even if the number is like, how much money am I making? Right? Like that's a number that a lot of people want to know and really can't answer the question
Right.
because
Right.
the IRS is going to calculate it different than your spouse on how much money
Right.
you make. And
Yeah.
so I think you got to know the number, and you got to be open to like, hey, we're not trying to put you on a budget, or you're not going to have to like go without food for a week. But it's like once you're aware of things, you naturally change behavior.
Yeah, yeah, which makes sense. Yeah, which makes sense. So let's talk about that behavior, because one of the questions that I see a lot of young doctors struggle with is this, decision that they have to make in terms of, do I pay down my student loans? Do I invest in my practice, with paying for additional technologies and things of that nature, or maybe, rebranding their practice or buying new equipment and things? Or do I build personal wealth? Like, do I start investing heavily in, a 401k profit sharing plan or whatnot? So, and I know this is probably a loaded question because there's a lot of different factors, but if you can go through some of this, like when you have someone that says, should I pay down my student loans, invest in my business, or build personal wealth? Like, how are you helping them? Like, what should they be thinking about as they make those kind of decisions?
Yeah, we do that a lot because what happens with a lot of practices is hopefully you have an idea on how much cash you should be having in your bank account or your business account, and when cash is too high, it means you need to do something else with the cash. Like there are a lot of doctors who have too much cash in their bank account. Sounds like a bad problem to have.
Yeah.
I mean, a good problem to have, but and then we go through this exact list of, what should you do with that money? Should you pay down student loans? Sometimes they want to buy a house. Sometimes they want to set up a retirement plan. There's all these different factors. And there is some psychology involved in this, meaning some people are really stressed out about their student loans. They maybe they're on deferment and it's a really low interest rate, and it's probably not the best use of their cash to pay that down because it's such a low interest rate. But mentally, they feel so much satisfaction and freedom by having a lower balance that I'm okay with that personally. But I will try to point out, again, there are a lot of people with student loans with pretty low interest rates before, interest rates went up recently.
Yeah.
That, it probably doesn't make sense to refinance or even to pay it down, to like stay on deferment a little longer. The balance might be growing a little bit, but that's just a high level. Obviously, we can go in like more detail on like the specific situation. But I think the idea of building wealth, though, you talked about like building personal, forget what you said, savings or wealth.
Building personal just wealth. Through like the 401k profit sharing plan.
Yeah, I mean that's usually like I'll try to push people to doing that first, of like set up a 401k plan, put money into there, and like start with that. So so like 24,000 a year that you're just chipping away and at least doing that amount. So like that's usually where we try to push people with extra cash first. And a lot of times if you have an extra 100,000 in your business, it probably means you're doing well and you're in a high tax bracket. And when you're in a high tax bracket, those 401k plans are a nice deduction in the current year. They're tax deferred, so it's not like you can just ignore taxes entirely. Right. But it's a good use of funds, and it's like a forced savings mechanism. You can't touch the money, which some people don't like, but it's not like a massive amount each year where like you will be disadvantaged. It's just a good like
Yeah.
forced way to save money.
Yeah. And it's interesting you say that because I think you're right. There's a huge psychological part of this that sometimes goes, unstated because some people just feel good when they pay off their debts no matter what, right? Like we had a general dentist years ago who just quickly was paying off his home mortgage. Even though he had a pretty low interest rate, he wanted to pay it off. He wanted to pay it off. Eventually paid it off like really soon. I think he had like a 30-year mortgage and he ended up paying it off in like 9 years or something. And so, but when COVID happened, I remember him calling me and saying, my office has been closed for 3.5 months, but he was relieved because he didn't have to worry about his home.
Yeah.
And so there's a certain psychological component to it. But what's interesting is I've heard, and tell me what you think about this, but I've heard from various experts, books I've read, that basically if you've got a loan less than 5%, no matter what kind of loan it is, you should just slowly pay it off, right? Like don't fast track it or whatnot because it's so low. But if you've got a loan that's in that 5% or more, you should work, hard to kind of pay it off as opposed to maybe, not necessarily as opposed to doing a 401k or profit sharing, but as opposed to like, putting it in a savings account or just the stock market in general, because to get that same return, you would have to get like 10, 11% on the market where, that's not always a given, in the short term, right?
Yeah. I think that's a good rule of thumb.
Yeah.
I do think there's going to be obviously nuances in specific situations, but I like that. I do think the last thing I'll say, just thinking about this, like I think getting an automatic savings in place, which is like the 401k and maybe even some IRA, like a backdoor Roth IRA, something like that, getting some savings in place, which is like, we're talking 30,000 a year potentially, right? So like a good amount, but not like breaking the bank. And then that I would put that as a high priority. And then getting rid of bad debt as a high priority, right? So kind of what you're saying, like, but credit card debt, like all that, any bad debt, you want to get rid of that. I would put that as a high priority. And then the other thing that I would put as a high priority of what to do with cash is investing in the business in a meaningful way. So I do think, if you can spend $50,000 in your business, A, that's going to be a deduction, but B, if that $50,000 can grow your top line 300,000, like, yes, do it in a heartbeat. I think, I do think sometimes people like, they go to a show and they buy a laser and then they don't really use the laser. Like there's a lot of that kind of stuff going on, which, the laser sales rep is going to tell you, oh, yeah, you only got to do one case a month and it'll pay for itself, right? Like but like you don't even know how to get that one patient a month. But if you're confident about like, hey, I can spend this money in the business and I think it'll really help the business, that's always a very good use of cash, in my opinion.
Yeah, no, actually, you're exactly right. I'm with you. I think when people spend money on a business, like there's two kind of components, right? There's ones that are revenue generating expenses and then ones that are not. So, I wouldn't spend $25,000 on a fish tank, if you because that's not going to it's not going to generate revenue for you. But spend, the money to get an intraoral camera or to get the latest technologies or whatever that you're going to use in your practice so that you can generate more revenue. But you're exactly right. I mean, I think those things go hand in hand because the more revenue you generate, obviously, top line, the more funds you have to put in a 401k, the more funds you have to pay off your debts,
Exactly.
quickly. So yeah, I'm with you there. Yeah. Okay. So let's shift gears. We're going to jump around a little bit just because this is how like the tax code is too. But like, do you have, we have a lot of doctors who are expanding and growing and they want to hire their first associates. And what I see sometimes, Travis, is that they will hire an associate, give them, a percentage of their, production or collections, and then soon realize that they're kind of losing money on the associate sometimes, and not really realize what their overhead structure was, and then they fire the associate, or they cut down days, or just sort of other things happen. But just at a high level, like, how do you recommend structuring compensation if a doctor is bringing in an associate?
Okay, so there's two things. I don't know if this exactly answers your question, but there's two things that I think about when someone wants to bring in an associate. The first thing is, most of the time you're going to pay them a percentage of production or collections, like you said. So do you know what your overhead is currently? And sometimes, like, a lot of people in the industry will use the term overhead, and sometimes they calculate it different. But basically what overhead should mean, and what typically means in the industry, is what are all of your office expenses before paying any doctor expenses, any owner expenses, or any like debt, tax, interest, those kinds of things. So it's basically like operating expenses. This is the number that people say for a GP should be 70% or 65% for a GP, ideally. But what is your overhead percentage? And if your overhead percentage is 70%, that means you're profiting for the doctors in debt 30%. And if you're going to pay your associate 32%, then you're losing, in theory, 2% for every dollar that they bring in. That's just a very high level number. And there's, you could go in nuance. But first, know what your overhead number is and know how that correlates with how much you're paying your associate. And that's a quick way to say, am I going to make money or lose money? Like with debt, you can get into some details on the calculation on that. The second thing I usually look at is are you adding an associate? Are you adding a doctor day to the office, or are they replacing one of your doctor days?
Yes.
If you're able to add an additional doctor day, so you're working 4 days a week, you fill up a fifth day, and that's where your associate is, you're adding a fifth doctor day, and then that's additional profit to the owner. So let's say, you're making 10% on whatever the associate brings in. That's great. It increases your bottom line. But if it's replacing one of your days, expect to make less as the owner. You could still be profitable on that associate. You're not losing money, but as the owner, you're not now, your butt is not in the chair. And that's when you make the most money. Now you're paying someone else to have their butt in the chair. And instead of making 30% or 40%, when you're doing that, now you're making 10%. So just having those two expectations going into having an associate, I think, are really helpful.
Yeah, no, that's super helpful. And you're kind of speaking my language, because that's exactly what we talk about and teach as well. Because I think sometimes the expectation is, I'm bringing in an associate and I'm going to just make money off of them. But you may not, right? You may not, with the examples that you gave, which are very real examples. I mean, we see it all the time. Whereas if you're paying someone a daily rate as opposed to a percentage, it's less likely that they're going to lose money on the associate with the daily rate, unless it's, the practice is slow, or maybe it's like a recent grad that's not, very fast. But when it comes to a percentage of their production or collections, you're exactly right. But I think, to your second point, what's really important for the audience to know is, when you decide that I want to bring in an associate, you don't want to just bring him in, next month, right? Like, you want to, or maybe I should say next week, you want to sort of think it through and say, do I have enough patience? Is that why I want to bring in an associate, to expand my days? Is it because I'm tired, I want to take more vacation, and I want to cut my days? Like what's the reasons for it? And then that way you can structure a contract that's, more in line with what your expectations are.
Yeah. 100%. Yeah, I think there are just a lot of people that think, I don't have to be in the chair, my associate will be in the chair, and I will make the same amount of money. And the math just doesn't say that.
Doesn't work out. Yeah, exactly. So, okay, so now let's talk about another math sort of situation that doesn't sometimes work out. So, you brought up your brother where, he had one practice and you guys were thinking of growing it into a DSO and growing it. And, sometimes that works out really well, sometimes it doesn't. We see a lot of clients who also have that mentality of growth. Okay. Now, the sexy thing to do the last maybe 10 years, albeit maybe not the last 2 years because it's kind of died down a little bit. But for the past 10 years, the sexy thing was I'm going to buy more offices or I'm going to open up more offices and I'm going to have just as many as I can, right? And what we're seeing now is people saying, you know what, I don't need 5 offices or 10 offices. I'll just grow my one office into a $3 million practice or a $5 million practice or whatever. I'll just expand at this location if I can, or I'll buy a building and expand in that building. What are some financial red flags that you would want doctors to sort of think about or watch out for when they're thinking about expanding or buying another practice? Like what are those questions that you're asking them to think about, Travis?
Yeah, it's a good question. I mean, I think we're pretty aligned on this, Ali. But because just from what we've seen, people that go down this road. The first question I like to ask is why? Why are you doing this, and what are you expecting financially?
Sure.
And the other question, that I maybe don't ask as directly, but I also wonder, what is this person's living expenses? So
Okay.
what happens a lot of times is, and I've seen this a lot, and I'm not like, if you've grown in multiple practices, this doesn't mean this has to fit you, but sometimes someone will have a good, healthy, single location practice. Let's say it does $1 million and it has, 35% profit margins, and it's a good practice. They're making $350,000 a year for one location, which is not bad. But they spend $500,000 a year, right? And so that they feel stressed. It's like they don't have enough money to go around, and the solution to them is to have another practice. I find that those situations don't work out well. You can only spread so much of you around, and you're already kind of in the hole and negative, and it's just you kind of need, when you grow another practice, you almost need to like spend less money personally for a little while to let that practice grow and flourish, and then eventually you could potentially have more money, but not right away. So if the motivation is like, I need to make more money to support myself personally because I'm already in the negative, that like sometimes just doesn't work out. But the other question, if you're going to grow into multiple locations, goes back to doctor days. So, doctor days and associates, I think. So if you're opening up other locations, how many days are you going to be working? Ideally, when you're like into like 2, 3, 4 locations, you're not the one doing the primary work. Assuming we're assuming a GP, like a specialist.
Yeah.
Is different when it comes to multiple locations, I think.
Right.
But for a GP, so then, how are you going to bring associates on board, and what kind of style will it be, and how much will you pay them? And obviously DSOs, you're going to have 4 locations, and these DSOs have hundreds of locations. Like, how are you going to make your situation more appealing than them? And I think that's always underestimated, how hard that can be to find and manage associates. But if you have a good strategy and a good plan, then I think that really is like a silver bullet on being successful in these other practices.
No, you're so spot on. You're so spot on, because we have a lot of doctors who start with 1, sometimes they go to 2, and they can still operate 2 practices, maybe even 3, just like they did the first one. But like you said, they're going to have to put associates in there, and that training, that attention to that detail, which whether it's HR, whether it's regulatory, or whether it's, just purely training the employees, whether it's doctors or non-doctors, it becomes like a full-time job in of itself,
Totally.
and that is an expense that a lot of people don't even think about when they're looking to expand. And then they lose the associates sometimes because of that, and they go, oh man, like it was the associate's fault. Not, they're not looking internally, and
Yeah.
and so that's a huge area. That's a
Yeah.
good point.
And you kind of mentioned, but all this assumes you like are a systems person and you have SOPs and you can like, have a similar standard of care across the board. Like there's a lot of other things that come into play having these multiple locations, but I do think that associate puzzle piece is one of the hardest to nail down.
Yeah, no, I agree. Yeah, especially in this market where it's hard to find associates across, across the industry. I mean, I think good associates usually want to open up their own office, and
Yeah.
they don't want to necessarily stay somewhere long term. And recent grads who need a job come in, but they're of course less valuable because they don't have the experience and whatnot that it takes to kind of work at a certain pace. So.
Yeah.
No, that makes sense. Okay, so I know you're at the forefront of technology because you're doing a lot of cool things at your firm, but how do you see AI and automation kind of changing the way CPAs work? And do you think it's a good thing? Do you think it's a bad thing? Tell me a little bit about that.
You're talking AI in the accounting space.
In the accounting space, yeah.
Yeah. Yeah, so there's some great resources. Oh, I could talk about this a long time, more than you want to talk about it. But there's some great resources out there on on groups and people that are really on the forefront of this that I'm part of. And with AI anything, I think there's like two immediate feelings that everyone has. It's like excitement that AI could solve this problem, and then fear that it could like go too far, or replace me or do some bad things or whatever it is, right? Because the accounting community has certain shortages of talent and other things, I think most people are like in the accounting space are really excited for what AI can do.
Yeah.
But thus far, and I think it will come, but thus far we've been all very much underwhelmed. And like a big pain point, for us is like the junior staff level, and there's a lot of data entry and a lot of like checking things, and it'd be great if AI could come in and like help
Right.
with these like more mundane, regular tasks. But even that, it's we're not even close to having AI. So I think it'll come. I'm not saying this like I'm very much like I use any AI thing I can all the time. But I think we're a little ways away. I also see one thing that I find happens a lot with people outside of accounting when they look inside is they underestimate the amount of just nuance that happens in accounting and
Yeah.
keeping transactions and giving advice.
Yeah.
And every situation is a little different. And AI can do a good job, but like piecing it all together, it's
Yeah.
I think people underestimate it. It will take a little while. So
I think you're right. I think it's good for general education. Like if somebody says, what is a P&L or how do I read a balance sheet? Maybe AI can help with doing that. But to get tax advice or business advice from it, it's probably not as, nuanced enough, like you said, to really apply to the doctors the way it is. And it's funny, I have a personal experience with this, very recently. We had a client we talked to like, man, it was probably Travis, it was probably like 9 months ago. Okay, like 9 months ago. And he wanted us to put together a partnership agreement. He decided to kind of not do it immediately, and ended up using a Chat GPT type of setup to create a partnership agreement. Well, lo and behold, they get into a dispute, right? And they're trying to rely on this partnership agreement, and it has nothing in there, like nothing in there about any of this stuff. And now, and this was just like 9 months ago, right? And they started their relationship like probably like 6 months ago. And so I mean, already they're like in dispute, and it might get pretty serious and go down the road of litigation. But to your point, it's like these things are just so nuanced that it's good for general information, but I would never rely on it for my business because everything's so unique, right?
Yeah.
So,
Well, I mean, my last thing, I don't think AI is learning extremely fast, right? And
very
I
fast.
think I think it'll get better. And my thought, and maybe this is not the best, but like, for example, QuickBooks Online came out with this big, super hyped AI update, and it's like supposed to be able to code transactions and stuff on its own, and it's been like a total flop, right?
Yeah.
If there was the ability to like instantly make your bookkeeping happen without needing to like chase you down for invoices and know what
Sure.
all the little like specific
Yeah.
things are, I would love to turn that on and charge my clients $10 a month for accounting, right? Like
Of
for
course, yeah.
bookkeeping, right? Like that's why I'm like, because I feel like the value is not in like the mundane tasks, it's in the consulting, it's in the advice and the direction and the strategy and those kinds of things, which I'd love to do more time on. But we're still spending so much time on this other stuff. So
Totally.
I'm very much open to more AI, but I think we're still a little ways away, especially on
Yeah.
the accounting side.
Yeah, but like to your point, it's growing so fast. I mean, in the last 6 months, it's grown immensely, and in the next 3 or 4 months, it's going to keep growing. So it's going to be really interesting. All right, so let's for this part of the podcast, let's talk a little bit about what's coming down the line. I think people are so confused by all the legislative and stuff that's happening at the federal level, at the local level. What are some tax and regulatory policies that you see coming down the pipe that doctors should sort of be looking out for or getting ready for, in 2026? So is there anything that's changing?
Well, on the 4th of July, Congress passed a one big beautiful bill. People on the streets call it OB3, the streets of accountant, OB3. OB3 passed July 4th, and that's a pretty big deal. But this is like the last time a bill of this magnitude, this size, impacting taxes was passed was in 2017. The end of 2017, right? So this is like not a very frequent type magnitude tax bill.
Sure.
But what had happened, it's the reason it's a little anticlimactic is in 2017, or we'll say 2018,
Yeah.
Trump passed, when he was in office the first time, he passed this big, massive tax overhaul bill.
Yeah.
And it lowered tax rates. It added this thing called a QBI deduction, which is like a 20% off coupon for business owners if your business was less than a certain amount, and added a bunch of other stuff. And it was all like, for the dental industry, it was all really good.
Yeah.
But this bill was supposed to expire at the end of 2025. So that it was like, it was so good they couldn't make it permanent, like to get
Sure.
past the budget. So it had to be temporary. The longest they could make it was 8 years. So it was all expiring at the end of 2025, which happens to be when Trump comes in office again. And so basically what happened on this OB3, One Big Beautiful Bill, is they made a lot of those things permanent now.
Oh,
so
okay.
so QBI is now permanent, lower tax rates permanent, 100% bonus depreciation is permanent, like all these things that you were going to have a big tax increase in 2026. Now that's not going to happen. So there is some good news for that. But I would say the biggest takeaway from all of that, and there are still some things to be ironed out, and the IRS is in like total upheaval right now.
Upheaval,
Like
yeah.
it's just crazy. But the biggest thing that I took away is there's this massive line that's drawn in the sand at $500,000 of income, and if you make more than $500,000 of income, it's basically like Congress said, you are ultra wealthy and we're going to rake you over the coals. You lose out on a bunch of stuff. You lose out on this QBI deduction, the 20% off coupon. You lose out on child tax credits. You lose out on, like, you have higher tax rates. It's just like you get raked. if you're under 500,000, it's awesome. Like you get all these, you're in lower tax brackets, you get all these extra write-offs and deductions, and I'm assuming married. So you're married, 500,000. So if you're single, it's going to be like closer to 300,000.
Yeah. So basically, 500,000 is a lot of income, of course, for most of America. But, for a lot of our doctors, no matter where they are in the country, between their incomes from their offices, profits, their spouse's income, and then, if they have any investments in real estate or other things, they're going to be above that 500. And I think a lot of people are going to be like, I don't feel like I'm ultra wealthy. I feel like I'm comfortable, but I don't feel like I'm in the, I'm not flying around in a private jet, every time I take a trip,
No, for sure. Yeah, no, it definitely like, I have my own feelings about it, but I'm not like, I'm not of the mindset that, we need to tax those people more, especially these doctors who invested so much time and energy in becoming a doctor. And so,
Exactly.
But yeah, I mean, I would know, a lot of people when it's, it's December, they're like, I gotta go buy my F-150, gotta go get that deduction or whatever it is. Well, I would know what your number is first, right? Like if your projected income is 600,000 and you can get that down closer to like 450,000 by maybe buying that milling unit you've wanted, or, there might be scenarios where it's like you spend 150,000 to get in a lower tax bracket, and you'll save fairly significantly now that you're getting into QVA. So just knowing your number, especially relative to the 500,000 mark, is going to be helpful.
Yeah, I'm a big believer that if you're going to buy something for a deduction, it's got to have additional benefits too, like bring you down to a lower income bracket, increase your revenue. Like it shouldn't be just for the sake of a deduction, because I think that's so silly, just on the face of it, right? It's like, if you want a deduction, just send me the $1 million, don't go buy something.
Well, the two jokes I see in my accounting community, which, if there are jokes in the accounting community, they're pretty dry. But like, one is like accounting or tax strategy is the only place where someone will tell you to spend $100 on something you don't need to save $15.
Yeah, exactly.
It's like, but but people, it's that $100 thing that you don't need that you want, and you're trying to justify it.
Yeah. That's how you justify it. That's right.
But you still had to pay $85 for that thing, right? Like, yes, it saved you $15, but it doesn't mean you should have still bought it. So
you should have still, exactly, and you got you got something you don't really need. Yeah, which is I think the main point of that joke. Okay, so let's transition to the next segment, which is real questions from our audience regarding tax questions that they've had that they sent us in from previous episodes. So I'm going to ask you two questions, and here's the first one, Travis. It says, Ali, every year I am paying a lot in estimated taxes, and then I get a refund the following year. Is this correct, or is my CPA overestimating my taxes?
Okay, this is a, I don't know that word, like a preference thing or a style thing. Every CPA has a different style for this.
Oh, okay.
I would say this is kind of my initial thought. So for example, it doesn't mean that one way is right or wrong. It just depends on how you want to do things. But if you're always overpaying an estimated tax payment, it's possible your CPA is calculating a like safe harbor amount. So paying 110% of your prior year taxes is a way to avoid penalties.
Okay.
So if you do that and your income did go up in a year, you could avoid penalties. So there is a reason to potentially pay 110% of your last year's taxes, which would, if your income's the same every year, then you'd get a refund the next year. Now, in theory, it depends how they're using that refund. You could apply that refund toward your next estimated tax payment and then just pay less in the future years. So that's not a like bad thing, but it also is one of those things that I would want to talk to you and understand your cash flow and how you want to manage your cash. If you're okay paying less than estimated tax payments, that could be okay. Just knowing you may have to owe some money in April or have a potential underpayment penalty, which usually isn't that major.
Yeah.
There's other, so a lot of dentists are S corps. Seems like that's a cool thing to do, to form an S corp. And so when you have an S corp, you have to pay wages. And so I usually, when I pay wages, I take taxes out of your wages so that we don't have to make estimated tax payments. I like it because we can put you on a salary schedule, so it happens every payroll. It's not these big quarterly lump payments that you have to make, so it's easier to manage cash flow wise. And then also at the end of the year, when we do our tax projections, if you're behind, if your income's up and you need to pay a little bit more in tax, if we push that in through your salary, you won't have an underpayment penalty. So if you're late on your quarterly estimates, you could get penalized. But if you're paying your estimated taxes through your wages, you can eliminate any late payments. As long as it's done by the end of the year, the IRS doesn't really see when it goes in through payroll. So yeah, so I think it's a lot slicker to do it through salary, take care of your withholdings there, and then if you're in a really high tax bracket, we don't want to pay you a ton of money in wages. So then we still might have to do estimated tax payments.
Estimated taxes. Yeah,
I like to start with wages.
Yeah, okay, that's good. That's good to know that there's not necessarily a right or wrong. It's just a preference thing. But 110% safe harbor, I mean, that's a pretty big increase from the previous year. I mean, that's a 10% increase from the previous year's taxes. So this person who was asking this question, that's probably what they were noticing, is that they may have paid 10% more every year, getting a bigger and bigger refund if their income didn't significantly go up, right? If it was just kind of slowly going up, they're just paying more and more, and they're getting more and more of a refund, So.
Yeah. Well, and I'll say this, as an accountant, like in the accounting community, it's a lot easier to tell someone they have a refund than they owe money, right?
Yeah,
so like
sure.
we're defaulting to give people refunds. Like the perfect world is you don't owe or get refunded anything. Like you just nail the projection.
Yeah.
But if I had to lean on one side, I'd rather give someone a refund.
Yeah, for sure. Of course. Yeah, so, that always makes everyone feel a little bit better. Yeah. All right, second question is, and this is actually something that I get a lot, which is kind of crazy because I like to do one of these things, and I'd like to hear your take on it, and I'll share mine. But it says, Ali, I'm looking to get a car, and I keep hearing different things about whether to lease or buy a car. What do you recommend from a tax perspective? And let's assume, Travis, that they own their own business, like they have a corporation, So what would you recommend, just high level? I know there's a lot of very personal stuff that goes into this, but what would you say?
So it's hard for me to answer this question and not from strictly a tax standpoint, because I feel like there's a net worth consideration to make, meaning you're buying an asset or just buying the right to use an asset. I think there's an argument for both, but I typically encourage people to buy if they can.
Okay.
So it depends on the car. It depends on how much they use it for business. It depends on how long they typically keep cars. Like, do they replace the car in 3 years? Does the car weigh more than 6,000 pounds or less than 6,000 pounds? Are they trying to get the electric credit for the car, which you can't get if you lease? There's definitely a lot of variables
to it. Yeah.
But I think just all factors combined, I typically try to see if people can buy. And if they buy, what I do, and I'm curious what your answer is. I don't know if it's the same one. But if they buy, if they're going to buy a car, and with the latest tax law, there's 100% bonus depreciation. So let's pretend it's over 6,000. If it's under 6,000 pounds, you can't use that bonus depreciation. But if it is over 6,000 pounds, you can use the 100% bonus depreciation. So let's say you buy an SUV and you're going to write off as much of it as you can in that first year. That's when you get the bonus depreciation. Well, the first year is a calendar year that ends in December. So if my clients are doing this, I'll usually tell them, buy the car in December, and only drive it for business for 2 weeks, right? It's hard to do that for a full year, only use it for business for a full year.
Right.
But say 2 weeks, only use it for business, keep a really good auto log, have good notes. And then that first year, they only drove 50 miles, but it was all business. And so that $80,000 SUV is now 100% deductible, and it's legit. Like, we have good notes. It's not like we fudged the numbers on anything, and it's a good ride. So I like that scenario if, someone's going to buy a car anyways, if we're buying. But there's plenty of reasons to lease. What's your answer?
Yeah, I mean, I think like you said, I think there's a lot of little things that make a difference in terms of whether to buy or lease. I tend to lean towards leasing only because I like driving something new every 2 to 4 years. I don't want to deal with maintenance. I don't want to deal with any of that kind of stuff. And my payment is 100% deductible, when it's a lease, if I'm using it just for, work, right? But like you said, if it's like 70% or 80%, but I think there's a real good argument for if it's more than 6,000 pounds, so which is most EVs, right? It's like cars like the Range Rover and like bigger SUVs that people are buying. I think you're right. I think there's a huge advantage to buying those and getting the bonus depreciation. Even though they don't hold their value very well, you're getting a lot of benefit from that, right? As opposed to your $2,000 a month lease payment or whatever, because it's going to depreciate so much that they've kind of priced it into the lease, right?
Yeah.
But yeah, I think unless it's like, and then if it's a classic car that's more like of a real investment, then it's like, buy that. Right. I mean, but that doesn't usually work as a business expense, so that's usually more of a personal thing anyways. So.
No, it's a great point. I mean, leasing, that's why I'm not like, and I always hate when people answer like, oh, it just depends. But like, there's a lot of nice things about leasing. It's simpler to calculate, simpler to manage. You don't have to worry about depreciation recapture, which is like, it's a complicated thing. If you did write off that $80,000 SUV, it may have consequences if you sold it in 4 years. Like it could not be good. Yeah. So, anyways, there's some definitely pros to leasing.
Okay. All right. Well, I think that's a good answer. All right. Let's transition to plead the fifth, which is the portion that I was telling you earlier, where we're going to turn up the heat a little bit and ask you to answer a question that is going to make you uncomfortable. You have two choices. You can either plead the fifth and not answer it, or you can answer it honestly. Now, no one's not answered it, so just so you don't want to be the first, but you can if you choose to. Okay, so here's you got an actually not a hard one, not too bad of a shocking one, but here's the question for you is, what's the most shocking thing that you've ever seen on a doctor's tax return that they try to write off as a deduction?
You gotta give me. I thought I'd be way more uncomfortable.
Yeah. This is not a super uncomfortable. I think Kunal likes you a lot, so this is like an easy one.
So the first thing that comes to my mind, I had a client. He was a very well-off doctor. He was an MD and I think a pulmonologist, made like $2 million a year. Yeah. And he got audited, and he did his own book. So this was at my old firm, and he would do his own books and then give it to us at the end of the year. And he was getting audited, and he wanted us to help him with his audit. And so we were going through his transactions that he had deducted, and there was a $150,000 expense for one night at a place in LA. Oh. And I Googled the place, and it was a gentleman's club. Oh. And we had to respond to the auditor, why are these all business expenses? So like I had a whole list of stuff. I'm like, why, can you please list why all of these things were business expenses? Yeah. That was on the list. And he had answers for everything, The answer for that one was that he gets a lot of referrals from doctors, and he was taking those other doctors out to network. So,
Did that work?
no, not at all. It was disallowed.
There's
So
a lot. I bet. Yeah.
now he did have a lot of other stuff that I was surprised that it was allowed.
Yeah, yeah.
But it was probably because there was just so much other stuff that they.
Yeah. They just focus on the big dollar one. They're like, we don't think this is reasonable. Yeah.
Yeah, but I didn't know someone could spend that much money in one night.
I know.
Anywhere.
Seriously, I thought it was just like rap artists and Hollywood stars that would spend that much in a night at a strip club. Yeah.
Yeah. So.
Well, good for them. All right. Okay. So, all right. Well, that's a wrap. Thank you so much, Travis, for spending some time with us and sharing all this really sort of important, information from a tax perspective on what these doctors need to think about and, what are some practical steps that they need to kind of consider as they're kind of going down these decisions that they make. And I think your point that you made in the beginning is probably one that everyone should sort of think about, which is it's easy to ignore your numbers because they're not something that you're used to seeing or comfortable with, but they can drive all the decisions in your business and your personal life. And especially with the tax situation that we're in right now, you can be leaving a lot of money on the table. So Travis, thank you for that. We've got all your contact details in the show notes and whatnot, but what's another great way for them to get a hold of you if they want to talk about their tax strategies and hire you to help with their accounting and tax?
Yeah, so feel free, check me out on Instagram or Facebook or LinkedIn, wherever you're at, and you can see our content. But yeah, feel free to reach out directly. My email is travis@gouluru.com. That's GOULURU.com. That'll be in the show notes. But feel free to reach out. If any questions, we have a team that we try to be pretty quick at replying to any inquiries. So
awesome.
Thanks for having me, Ali. It's great being here.
Yeah, my pleasure, Travis. Yeah, this was a lot of fun. And if you guys enjoyed this episode, please do us a favor and like or comment and subscribe to Ali Off the Record. And we'll see you next time. Bye, everyone.